the fact that we're likely to see money remain tight, we're also likely to see a continued flow of significant bond selling by the U.S. Treasury as a function of the continued elevated deficits. The Treasury is basically committed to say that they are likely to issue the same share of bonds versus bills on the deficit for an extended period of time. And so what you see here is a basic story where the amount of gross issuance, total bonds and notes gross issuance, is likely to remain at basically secular highs in an environment that's very different from that previous high when there was substantial money printing. We continue to have the Fed to a modest extent roll down the balance sheet or slow the balance sheet, and we continue to see this pressure of constant bond sales coming into the market. Any one day, of course, those bond market sales can be absorbed, but over a period of time, in one form or another, asset prices need to fall. And when I say asset prices, I mean aggregate asset prices, right? So something like an RPAR, a balanced portfolio of asset prices needs to fall in one form or another, given the constant supply and quantitative tightening that's coming into the market. And that's only exacerbated by the fact that the Federal Reserve continues to run monetary policy that's relatively tight for an extended period of time. So given these pressures, the real question is basically, how do you get the next 10% leg up in either stocks or bonds? And I think the story that has to be told is pretty challenging. It's a pretty challenging, needle to thread in order to get an environment where that next leg up in asset prices actually occurs. And then the pressure on the U.S. bond market, I think, is particularly important when you think sort of globally. Like globally, the world is benchmarking off of the U.S. bond market. Basically all assets in one form or another are being benchmarked from it. You see there in the upper left-hand corner, the shifts in the bond market, the up move in April and then the down move and chop over the course of the last 6 weeks. That basically aligns with what you're seeing in terms of the bond market action in the UK. U.S. conditions are different from those in the UK, yet the UK bond yield is basically trading on U.S. conditions with slightly less beta. You see that in the stock market. In April, the bond yield rise creating a drag on the stock market, and then the resolution creating a lift. You see that in global commodity prices. They're shown with the CRB. And so you add that all up, and you actually see a situation where, the U.S. bond yield, what is transpiring with the U.S. bond yield, it becomes the central lever to what's going on with the world.